slide that shows which percentage of what is the percentage of companies that have raised money in a given quarter, what percent were up rounds. So you can see when looking at kind of the shape of this chart, and it's a shape that's going to be familiar, that in 2007 things were pretty good, and things started to tail off when we hit the recession, due to the mortgage-backed securities problem and the like. And things have been improving since then, and we are approaching 2007 levels. So again, what does this chart mean? Each quarter, we look at the companies that raised money in that quarter, and we compare the price that they raised money at to their previous financing. So that would have been 12, 18, 24 months prior to that, and determine whether it was an up round or not. And if it's an up round, then it shows up as an up round. One of the things we base it on is we do not base it on valuation, but actually price per share. Valuation we find is a number that can be, not intentionally, but can be manipulated. You just increase the option pool, your valuation increases, but it doesn't really mean that any value has been created for your investors. So we focus on the price per share. So, if your last round was $2.50 a share, and then 18 months later you do a $3 round, that's an up round.
I'm Ann Lindblad, the co-founder of Lindblad Venture Partners. We are in our 23rd year as a venture fund, and we're doing the same thing today that we did when we pitched to our LPs 23 years ago. We are a focused fund. That means we only focus on one thing. All of our partners do one and only one thing, and that's invest in early-stage software companies. And by early stage, we mean A rounds. Our focus is also primarily B2B. Although we did a short stint in consumer investing, most notably Napster, we have not done a consumer deal for about 12 years. Our focus is to really pick a select set of new companies each year with their A round. We syndicate our A round deals with other leading venture capitalists and help build very large companies. Our competitive advantage is software. When we started in 1989, there was about $300 million across the entire U.S. invested by all VCs in software. The compounded annual growth rate of software is at its highest point almost ever right now. And last year there probably was about $10 billion invested in the U.S. in software companies. So it has finally become the robust growth sector we hoped for, and that is our competitive advantage.
Thanks, Ian. Rob?
Hi, my name is Rob Chaplinsky. I'm the co-founder of BridgeScale Partners. BridgeScale is kind of what the name represents. It's providing bridge capital to help companies scale. My co-partner Matthew Cowan and I worked at Intel in the early 90s together, and I'm now in my 16th year as a venture capitalist. We saw an opportunity in 2005 to raise a small later stage growth fund. So the investment thesis was around the mean time to liquidity is lengthening. So venture returns were under a lot of pressure, just how long it was taking companies to get an exit. We also recognized that a lot of the funds were very large, that we could deliver to our investors a better return with a smaller fund. And we like to focus on the growth sectors of technology. Today we have a portfolio of around 20 companies. We have a strong mix of Canadian investments in our portfolio. We leverage our cross-border relationships there. In fact, our Canadian deals have outreturned our U.S. deals by a significant percentage. And it's for a variety of reasons. Although the majority of our deals are here in the Valley. Our competitive advantage is we invest in over 100 companies. We focus on technology. We leverage our network. We run a social network called Digital Puck, where we have over 300,000 Canadian expats here in the Valley, and we leverage that network to help our companies scale. And we don't focus on clean tech. We focus on everything involved in IT.
So I'm Paul Matucci. I'm a general partner at U.S. Venture Partners, and we have about 85 companies in our portfolio across 4 funds. apparently not enough of those are Canadian companies, however. We are a diversified fund. It's our 10th fund that we're currently investing. It's a $630 million fund, which probably means there'll be somewhere between 50 and 60 companies in that fund when it's done. And it will be done probably in another year and a half. It's diversified to be about a third clean tech. I'm sorry, a third medical and healthcare, about 10% clean tech, and the rest being information technology. We're 30 years old as of this year. We were celebrating our 30th anniversary, and it was a good party. If you came, if you weren't, we'll leave me your card. I'll invite you to the podium. I've been doing this for 10 years. I do all IT. My focus is both consumer and B2B internet and storage, because I have a legacy storage background from my years in DevTech. Our competitive advantage is that we have staying power in the industry, which is becoming more and more important as you try to put syndicates together at the early stage, and that we have roughly half of our partners are former entrepreneurs, venture-backed entrepreneurs, CEOs, so we have a strong operational focus in the company, which allows us to help companies more at the early stage. We do some Series B, Series C stuff, but it's really only about 10 or 15% of what we do.
As it was mentioned, I'm an agent. Not really that type of an agent, more like that type of an agent. And I don't need to tell you, you're all very, very smart, that I'm an agent in a world where there are obviously huge disruptive technologies, there are incredible changing consumer behaviors, and it's all leading from these companies working with these companies very, very carefully. And a traditional agent does this. A traditional agent takes an actor and puts them together with a studio or a network, and they go and they make Pirates of the Caribbean. But what we do at UTA is much, much more. We combine all of these factors. And in all of these factors, and we bring them all together to the table, and we try to figure out what to do and how to really enter into the brave new world. And within all of this, the question, of course, that we always get, and it's the question that we always hear, is how do you measure the ROI? And that's what I'm going to try to demonstrate for you today.
David Russick. I'm the founder and CEO of 7Echo. 7Echo is a social television platform. Our patented software enables friends to connect inside of and as part of TV shows that are delivered online and through social networks. These shows are primarily interactive. We've implemented up to 9 shows at this point, and we're very excited to be launching within the month what we see as the first social television reality program that will be launching called On the Map. So look out for it, and great to be here.
Great, thanks.
Tim Lee, I'm the co-founder of a company called Visa. So we are also a social TV company. We have been in this space for about a year. And we started off because we saw the same thing that you guys probably see, that we saw that 70% of TV watchers are using a second device while they watch TV. So we're like, hey, this is a really interesting opportunity. So about a year ago, we saw it was really simple. We started by introducing check-ins in the same way that you might check into your location, you check into your TV show. So a really simple social experience around TV. We wanted to start small and see if anyone cared. Some people did. We had a lot of early adopters. We have about 250,000 users right now. So a small percentage of people, but they're very, very passionate TV watchers. And we came to realize over the course of the year that people wanted to have a deeper second screen experience than just checking in. And that's what we had been working on for the last year. So we realized that that synchronization was a really important key. So we partnered with AT&T and DirecTV to actually allow you to open up your iPhone and connect directly to your set-top boxes, so we know exactly what they're watching and where they are in it. And we're working now on releasing a publishing platform where people can kind of connect with their friends and produce content for each other in the same way that you might tweet out something, but you would have a specific way of sharing what you're doing while you're watching TV, like whether it's a quote or whether you want to trash talk your friends while playing sports or something like this. So we've just released this. We call it Sideshows. So we'll see, I guess, what synchronization and Sideshows and community can kind of do over the next year.
So I'm Anne-Marie Roussel. I'm the head of acquisitions and partnerships for Sharp. Electronics, Japanese company. It's a consumer electronics company for those, probably not too many of you who don't know it. Mostly TVs, cell phones, a lot of various businesses in Japan, including solar panels and a lot of different things. I concentrate here on developing the next generation TV business. As you know, Shop has mostly been in the hardware business so far, making screens, making a lot of the hardware around the TVs, but we're now moving up the value chain and looking at what we can offer in addition to just the hardware. So that's the reason why I'm here today. I'm looking at opportunities to either invest or acquire whatever enabling technologies around the social TV space. I really don't believe that if a big company should reinvent the wheel. There's plenty of very interesting little startups like the ones here today that do very interesting things, and we can collaborate or help them grow so that we can grow our own business.
Hi, I'm Jason Krikorian. I currently general partner at DCM. We're an early stage venture capital firm. Been around since '96. We make investments in the US, also in China and Japan. But I'm here probably not from any investing, which I've only been doing for about 1.5 years with DCM, but I was also co-founder of a company called Sling Media. We had a product called the Slingbox, and my brother and I co-founded in 2004, ultimately sold to Dish Network, EchoStar in 2007, and just very happy to be here. Thank you.
I'm going to let everybody introduce themselves. I'm Mark Stevens. I'm a partner at Duncan West. I've been doing games work for the last 30 years and work with a few dozen game companies, including Electronic Arts and Gaikai and Unity and a bunch of other interesting companies. But it's been a resurgence in the last couple of years in interest in gaming, so spending a lot more time with companies doing up rounds in larger transactions these days. So, but Haney and Lars and Jeff, want to start with Haney?
Sure. Haney Nada, I'm a partner in Granite Global Venture, GGV Capital. It's about $1.5 billion venture fund that was started in 2000. I focus on the digital media space and particularly gaming investments. GGV, we have 8 gaming investments across both the US and in Asia. We've got a pretty big office in Asia. We've invested in companies like Turbine, Xfire, Wild Tangent, Blue Mobile, some Chinese companies, YY, 7K. So there's a lot of companies in the portfolio that are in the gaming space. Quite active in that space. Before Piper, I was actually a research analyst on Wall Street, and one of the segments I covered was gaming. That's actually where I met Lars.
Yes, and I'm Lars. I'm the founder and CEO of Triumph Worlds. Triumph Worlds builds video game quality franchises for the connected world. All of the games we build are live, can be updated in real time, can be changed in real time, and but have console quality. I used to be the vice president for global online at Electronic Arts, and then at some point just moved across the street, set up Triumph, raised over $100 million, hired over 400 people, and built a completely next-generation platform, and then started to launch big games on the platform. The one we launched this year is called Rift. We announced that we reached over 1 million fully monetized customers in under 4 months, and we have been growing ever since. So we believe it's a super exciting time for gaming because everybody has a connected device in their pocket. And if you make games for a world of connected devices, you can fight piracy, you can have all kinds of business models, virtual goods, subscriptions, advertising, all of the above, and you can develop content around every single player, and you can also, over time, develop monetization around every single player and optimize your content for every single connected device. So gaming is going to be the most exciting mass entertainment of the future, and we believe that Triumph is, in terms of its DNA and technology architecture and values and everything else, built perfectly for that world of connected devices.
And we'll challenge that in the course of this conversation.
My name is Jeff Bell, and I should say I'm a partner at NCT Ventures, which is a small venture capital firm that I started when I left Microsoft, and one of my roles is also to be the chairman of one of our larger investments, New Media, which I just spoke about. But I'm up here because prior to that, I was the corporate vice president of global marketing for Xbox, for interactive entertainment at Microsoft. And I have a great passion around advertising and branded entertainment as it relates to video games and entertainment consumption generally.
So e-commerce for up until about 18-24 months ago hadn't seen much in the way of innovation for at least 10 years. If you took the list of top e-commerce sites from 1999 and compared it to 2008, 2009, it would be virtually identical. It would be Amazon, eBay, Netflix, Walmart, all the way down the list. But right about the time of the recession, 2008, 2009, some real innovations started occurring. Groupon and Guild Group and a whole host of other folks really started changing the model and gaining tremendous user adoption quickly and scaling revenue. And a lot of the innovation has accelerated from those few. And now we're seeing just incredible new business models and user experiences that have gotten people very excited again about a whole new wave. And a lot of this wave is being thrown under the rubric of social commerce.
Brian, founder and CEO of Keep, we're a rewards network, and what we do is we leverage existing popular mobile games to use the moments of achievement in them to reward you. And so these rewards are usually from large top-tier consumer brands or e-commerce sites as well, and what it's really sort of hinging upon is this new inventory that's completely been unleveraged in games that we call achievement moments. And so in that moment, we're able to capture and sort of tie the happiness that is associated with that to the brand, and we let them complete their transactions after they're finished the game, of course, from email. But that's really the gist of what we've been up to.
Great, thanks.
Hi, Osama Fayyad. I spent a career in science, but then after Microsoft, started one of the largest behavioral targeting ad networks out there, Audience Science. Spun off a company from that got bought by Yahoo, so I was EVP and Chief Data Officer at Yahoo for 4.5 years. After leaving Yahoo, hooked up with a couple of co-founders who are also on the Yahoo team, and we started ChooseOn. And ChooseOn, you know, I don't know about you, but anytime I buy anything these days, I feel guilty. And I feel guilty because I know if I spend a few hours on the internet, I could probably find a major discount for it, 20 to 40%. However, if you try to do that, you go on Google and search. It's a very bad experience, hard to find the right deals. So what ChooseOn does is basically it combines two things. One is all the feeds of all the offers out there, from loyalty programs, from daily deals, from merchants, from deep discounters, from private sales clubs, and combines it with knowledge about you. So we know, you know, Brian might like these kinds of items, these kinds of brands, and most of the other stuff is irrelevant. So we make the most relevant deals surface at the right time, in the right context, at the mall, or when you're shopping online, on the mobile, etc. And we believe, you know, that this is a very interesting play on the deal economy that's out there. Everybody's obsessed with deals. There's a lot of overwhelming chaos of deals out there. And at the same time, it helps the brands preserve their brand and avoid becoming sort of a race to the bottom where it's all about price. It becomes about relationship and getting the right offer to the right individual at the right time.
Thank you. All right.
So Lorraine McDonough, I head corporate development for eBay. It's been a really busy year for us on the acquisition front. We've consummated over 12 transactions for a total aggregate value of over $3 billion. And I think we're going to continue to be active through the upcoming year.
We forget that Apple actually provided us with these incredible tools to do marketing. So Apple's tools helped us do better marketing because we could integrate all the marketing. Everything was digital now. We could develop ads, packaging, even video editing using Avids back in our day on the same basic computer platform. So this was the amazing breakthrough, because what this translated into is the idea of integrated marketing communications